You're listening to Macro Sunday, hosted by Andreas Steno. Happy Sunday, everyone, and welcome to the Macro Sunday podcast. I'm Andreas Steno, founder and CEO of Steno Research, and this is your independent macro podcast out each and every Sunday. It's been another roller coaster way, to say it the least, in the US Treasury market, with spillovers to risk assets, to the US dollar, you name it. And Emil Møller, my true lieutenant, welcome to you.
Cheers.
Head of research here at Steno Research, and typically my partner in crime for this show.
Definitely.
Oh boy, a week. We have
That's it.
plenty of things to discuss, not least when it comes to interest rate markets. And therefore, we've actually teamed up with potentially the only great analyst I know out of Tokyo, able to explain the ramifications of decisions taken in Japan for global fixed income markets. We're joined by Weston Nakamura in 10-15 minutes from now for a discussion on Japan and the spillovers to the Treasury market, and whether the Bank of Japan decision actually started the snowball effect that we now see towards lower yields in US Treasury space. But before we get to that, remember, as a broad disclaimer, that the ideas discussed in this studio may sometimes be
sometimes may be good, sometimes may be shit.
Yeah, good old. Yeah, we get and playing it twice from our studio.
Yeah.
Why not?
Why not?
They've been more shit than good this week. Well, to a certain extent, it's been a mixed bag of goodies.
Yeah.
But never mind, because let's have a look at the details before we invite Weston to join us. I'd like to start with sort of an overview of events driving these Treasury yields this week, Emil. First of all, a lot of focus was given to this QRA, the quarterly refunding report from the US Treasury, out on Monday with details on Wednesday.
Yeah.
Overall, dovish vibes, but are they fair?
Temporarily, yes. I think another aspect that's probably goes a bit under the radar on that is, from a risk-taking standpoint, if you don't know what the issuance plan is and you can wait, and your thesis is not trading the exact issuance plan, but the underlying economy and the entire momentum behind US Treasuries, why not just wait till you know it? And we got it, and markets are partying. So cheers to that.
To say it the least. Q4 issuance down 76 billion versus the last update 3 months ago. The issuance for Q1 is above 800 billion again. So we are temporarily lower before heading higher again Q1 next year.
And I would argue before we head even higher. So that's
especially if we get into a recession, right?
Oh
boy.
Yeah.
But from a liquidity standpoint and from an issuance standpoint, fairly benign news, very short term. I think that's safe to say. One thing to notice here is that the Treasury General Account, so the cash buffer that the US Treasury already holds, is running above target levels already. So they did not raise the bar for the liquidity buffer that they intend on holding. A bit of a surprise to us, but maybe we'll see next time, right? But they still intend on sort of a target balance of 750 billion, and they're running above 800 now. So, I mean, the buffer is there. Which is why they don't need to sort of over-issue short-term, given this. And I mean, a lot of focus was given to this report. A lot of people feared like the issuance bazooka short-term, and obviously that risk is taken off the table very short-term.
Yeah.
But if we look at the data out of the US economy this week, it was basically fuel to your story that we're not too far away from a recessionary scenario. So, I mean,
basically,
given that cocktail, where are we headed here?
So my thesis since summer has basically been we would see some restocking. We will see some resilience in the demand in the US, and that would perhaps surprise markets. It at least did back then, and to the extent that it has carried on, it has kept on surprising even us at times, right?
Yeah.
But I was not really in doubt that eventually we were going to hit the wall. and it's going to surprise markets. The question was merely the timing, and my operating thesis was that maybe November at the earliest, but I would probably have put my chips on it coming a bit later. But alas, here we are, and well, I think it's just more fuel to my recession for Q1, really. But still some way to go on that score. Job market has has still to really cave in, but I think it's coming, and I think this is sort of, well, not the first domino, but at least one domino. So,
And then we have Jay Powell.
yeah,
Obviously, the nickname for Jay Powell,
Yeah.
the chairman of the Federal Reserve.
Mm.
He took stage on Wednesday
yeah,
with kind of an ambiguous message to markets. First of all, sort of acknowledging that vanilla data, inflation momentum, growth in Q3, the last non-farm payrolls report before the one we got this week.
Yeah.
I mean, all of the information he sort of had on Wednesday
yeah.
basically surprised to the upside compared to the last couple of meetings.
Yeah.
They acknowledged that rhetorically, but with a very weak wording, right? Moderately. I mean, it was obviously their intention not to try and sound hawkish here. And then on the other hand, he also almost passed the responsibility of U.S. Monetary policy
Yeah.
to markets,
Yeah.
saying that the steepening of the curve, the term premium developments, all that basically allowed the Fed to take a more cautionary stance here from a rate hiking perspective. So what's the feedback loop introduced here like?
Well, it depends on how the data pans out, right? But essentially, what this really is just a confirmation of policy up until now. I mean, has the Fed really surprised the market at any turn these past months? Not really. They're completely explicit about not having a clue where things are going. So they say, fine, we leave it to markets and market pricing, and well, okay, the long end does a job for us. But now they probably turned the dynamic a bit on that one, and that could come back to bite them in case we don't see data really undermining the inflation momentum. So that's the other part of the coin.
So here's my point on this topic. When you allow the market explicitly to dictate trends, also for monetary policy, you also introduce a feedback loop where weakness in bond yields, say over the next 10 to 30 years on the curve, automatically spills over to a more hawkish reaction function. That's basically what he said yesterday. If the opposite is true, that a steeper curve, higher term premiums will allow them not to hike as much. Then if we reverse those trends, and we're currently amidst reversing those trends given the green light he gave to that,
twice the pride, double the fall.
Yeah, exactly. Then they, I mean, you could end up in a scenario where they have to hike in December to send a message to markets again.
Yeah, you should.
That's basically my base case right now. I know it's contrarian, but if markets are allowed to rally both in bonds and equity terms here, why not hike in December to try and take control back?
Yeah,
because are they? Is it really what they want here? A rally across all assets? I'm not sure.
It's what Yellen wanted.
Yeah, sure.
I think you're fundamentally right on that. What sort of is my perception at this point is that I think that the weak momentum in demand will essentially undermine that feedback loop. But you're right, it's a risk. So we are kind of ambiguous here, right? I think what we really set up for, at least for this month, or perhaps shorter, is basically a bear market rally. I mean, that's what it looks like to me. The lid off on the long end yields. Assets have been battered left, right, and center for months. Finally, you see some tailwind, and now everyone's back in town, right? And I think it will end in tears. I think the safe trades right now, buying the 2-year, buying, all the, all the simple low risk, a decent return that could operate in a disinflationary environment. That's sort of the easy path here. But yeah, I think especially given the composition and the issues that there are in American politics, I think it's really tricky. I mean, we see a shutdown. What happens then? It's certainly a high probability, right? Definitely have it drag down GDP, which is already getting battered if you look at vanilla nowcasts and whatnot. Add to that, I think the CBO. I'm doing a piece right now, and crunching the numbers, but it looks pretty clear to me that they're very much underestimating the necessary amount of debt that it would have to be issued unless
for 24.
Yes, for 24. Unless we see some fiscal consolidation, and that would require the House to pull a rabbit out the hat. Don't really see it coming, but it could. We shouldn't rule it out. Normally, politicians, they tend to actually operate in a more responsible manner, but it's a tough ask in this environment.
Good luck consolidating a budget through a recession.
Yeah,
and it's not even recommendable. So.
Oh, we've done that experiment in Europe. Not recommendable at all. No.
Emil, we also had the Bank of Japan meeting.
Yeah.
And the short take here before we bring Weston Nakamura onto the show to discuss this with us is that Bank of Japan now tries to increase their flexibility instead of chasing certain targets on the yield curve. They've basically turned their policy into one big mess. You cannot count on anything from here.
No.
And everything is up in the air. And interestingly, that was maybe the first catalyst for lower bond yields in US Treasury markets. They've had a very clear direction on that cap for the yield curve.
Yeah.
Now, it's tricky to figure out. So why don't we invite an expert to the
let's
floor,
do it.
straight out of Tokyo. And as per usual, we introduce our guest of the week with a piece of intro music. And since we are on a trip to Japan, why not play Alphaville Big in Japan? To introduce an old colleague of mine to the Macro Sunday podcast, Weston Nakamura, former Goldman, former Jefferies, former Real Vision, together with me, and now the founder of Across the Spread. It's great to see you, Weston. Thank you for joining us.
Yeah, great to see you guys too. Thanks for having me on. I thought you were gonna say old friend of mine, but yeah, old colleague, I guess.
Same, right?
I see how it is. Yeah.
But certainly a friend of mine as well, Weston, and it's great to have you live with us from Tokyo, given everything that's been ongoing in Japan this week. We've had quite the roller coaster action in the dollar versus the Japanese yen, with both a meeting in the Japanese central bank and the Federal Reserve. So what are your sort of takeaways from this week of action in dollar yen now that we're trading above 150, the important handle?
Sure. So this is going to be very hard to condense, given all that. But okay, so basically, what happened was you have the Fed was basically in line. So that part wasn't really a factor, but obviously the Bank of Japan having changed its yield curve control policy, that certainly was a factor. And then in addition to that, you also have overlaid on top of that the yen itself, dollar yen, above 150 and getting very close to those October 2022 highs of when the Ministry of Finance did their second of two rounds of intervention last year, smacked dollar yen down like 5 big figures in like half an hour. But that marked top tick in USD JPY as well as 10-year US Treasuries until as of recent and cause a kind of turn in global macro markets worldwide. So you're basically just about 1% or so, maybe less than that, away from that level of intervention. So that's also overhanging as well. So there's kind of these different bodies. The Fed actually being the least of them in terms of significance for dollar yen itself. In comparison to like the Bank of Japan Ministry of Finance as well.
Weston, if we look at this change of the yield curve control, the former moves that they've made, Bank of Japan, they've basically given us, say, a new cap or a new target range for the 10-year JGB yield. Now that answer is basically blowing in the wind. We don't know exactly whether there is a cap to the 10-year yield or whether they intend on having some sort of de facto cap by the end of the day. So how do you view this change to the yield curve control and the new flexibility added here?
That's exactly what they did, Andreas. Like, so big picture. Okay, what Bank of Japan has done in October is a continuation of what they did in the July Bank of Japan meeting, in which they lifted the band from 0.5 or 50 basis points to 100 basis points. But that's really, it's really not what the big picture is. Big picture is as follows. Basically, it's not about yield curve control levels themselves or inflation or the yen for that matter. It's basically about the Bank of Japan is attempting to reclaim their control over yield curve control back, or as I call it, YCCC, yield curve control, right? So essentially what you have is this policy shift that began in July Bank of Japan meeting, right? They that upper band was removed from 50 basis points to 1%. But at the time, JGB yields were at 50 basis points. And, they didn't think that, although they put in a 1% upper band, at that time, they didn't think that it would hit that. So they just put that in for kind of good measure. And we can come back to the fact that it's almost hitting that now. But basically, in July, that adjustment was like that was the first time they made a yield curve control alteration without making an explicit next level higher, and rather they just kind of started this campaign of, as you said, flexibility in their buying operations. Flexibility is basically what that means is that like it's just about not just what level of JGB yields, but the pace in which yields move, as well as the different tools that they have to execute their buying, when they buy, where on the curve, at what level, at what notional about. Flexibility or optionality is what Bank of Japan had completely been depleted of. And because of the past, by putting these like hard cap levels on where 10-year JGB yields are, they would paint themselves in a corner, right? Because markets would press them up right against 25 basis points, 50 basis points. But by injecting uncertainty and ambiguity into markets as to where are the goalposts now, they're reclaiming their control over how yield curve control is in and of itself conducted. So it's at the expense of us market participants understanding of how the Bank of Japan operates is what the big picture is.
Weston, I remember a conversation between the two of us after one of the first moves in the yield curve control in December 2022. And I remember under the former president of the Bank of Japan, that Bank of Japan had to be extremely active back in January and February of 2023 to control things. So what is the plan here? Do you see Ueda being less active in the curve now that they've added flexibility? What's his plan here?
I remember that as well. That was insane. So you and I spoke. It was in January, right? So in December of 2022, that's when they did their first shock from 25 basis points up to 50 basis point change, right? And I think that there was a lot that they learned from that experience that is currently influencing what the framework is now. So when they did that in 2022 in December, right? Basically, like I said, although they lifted it, they still had an explicit cap, 50 basis points of new cap, and the entire market sold JGBs like crazy and pressed them up against it. And that forced the Bank of Japan to have to defend that new upper band, such that the Bank of Japan in January of this year, of 2023, the Bank of Japan had to buy about 180 billion USD notional worth of JGBs in order to fight this like market sell pressure to hold that new level. Okay, and just to put it in perspective, $100 billion USD worth of bond JGB buying in BOJ in January of this year. That's about 50% more bond buying or more QE than the Fed was doing at its peak QE. So that's like the scale of what they had to do to defend that. So anyone at that time who thought that, December 2022 raising yield curve control bands was, like the beginning of a tightening cycle, you tell me if 50% more QE in the following month, more than Fed peak QE is like sounds like policy tightening, right? So it's ironic that when they did that, they had to just do more easing, that on record than ever. So that's how it backfired. But it backfired because also it backfired against BOJ in attaining their stated goals, which is they lifted yield curve control bands in the first place because they wanted market functioning, not to kind of smoothen out, right? This kink in the JGB yield curve where 9-year JGBs would not only be yielding higher than 10s, but they were yielding higher than the yield curve control cap, right? So they thought if they lifted it, they could smooth out the yield curve and all that kind of thing. What they're terrified of right now is that happening again. So if they put out a level out there, even if it's like 1.5% 10-year JGBs or something like that, the markets are eventually going to press them up against that level, whatever that stated level is, and then you're going to get market dysfunctioning again. And so, this policy is going to be it's like you said, very hands-on. It's very mechanical. How they kind of control the pace of the yield curve to steepen, I suppose. And they're using all these different tools. I have like this chart, that of 10-year US Treasury yield as well as the 10-year JGB yield, and you could see from that moment in end of July when they just went on this new flexibility mission to reclaim yield curve control. You could see all of these points in which they're using different tools, be they these unannounced, unscheduled competitive rate buying JGB auctions or fund supply operations, which is basically when the Bank of Japan is lending to banks, at very low rates, so that banks can then take those funds and buy JGBs on Bank of Japan's behalf. And by the way, Governor Kuroda at the time when they first rolled out said that they could actually make that rate negative, i.e., they could be paying banks to buy JGBs for them. But they're doing all this so that they could avoid these fixed rate, unlimited buying operations and slowly guide the curve up. And that's going to require very heavy hands of the Bank of Japan in and out of markets and tweaking things and all that. So, yeah, they're going to be more active than ever.
Yeah. The discussion of the on the yield curve control obviously also partially relates to the level of the Japanese yen versus other currency pairs. And we're now trading above this 150 handle. We discussed it initially. And one of the things that many foreigners struggle to understand is who's in charge of the FX policy when it comes to the decision making in Japan, because we have the Ministry of Finance and then Bank of Japan both involved in this. So, Weston, who's in charge, and where do you see the line in the sand for this currency pair dollar yen?
I'll tell you who's in charge. The United States dollars is in charge. But you bring up a very good point. This is something that I always try to address, because often you hear kind of just in regular parlance that the Bank of Japan is intervening in FX markets and all that. While that might be technically true, that the Bank of Japan is doing the actual act of buying and selling US dollars and buying Japanese yen and all that, the Bank of Japan itself is not the decision-making body that is doing that. They're acting as an agent on behalf of the Ministry of Finance, which is the Japan's equivalent of the US Treasury Department, right? It's elected officials in government. It's the Japanese government. The Bank of Japan doesn't concern themselves with FX. Ministry of Finance makes that decision. Suzuki, who is Janet Yellen's counterpart, and Vice Minister Kanda, who is the chief currency diplomat of Japan, they're the ones who ultimately make that call. And a little fun fact for you, if you will, Bank of Japan Governor Kuroda, although he'll, former Bank of Japan Governor Kuroda, although he'll forever be remembered in history as Bank of Japan Governor, he actually started his first few decades of his career was at the Ministry of Finance, and he actually held that position of Vice Minister of Meddling in FX position himself. So that means that he knew the game in and out, and yet he still allowed for USDJP or for the yen to get crushed during his tenure. So that shows you what that kind of relationship is in terms of the Bank of Japan and the Ministry of Finance being kind of at odds with one another.
Yeah. We had an interesting flash crash in dollar yen when it touched 150 for the first time. Was it 3-4 weeks ago? And it started a lot of speculation on whether it was an actual intervention from the Japanese authorities in the dollar versus the yen, that flash crash. So was there intervention, and how would they communicate it if we are to see intervention in the cross?
Yeah. So I actually wrote a very, very long piece. This is the first publication I did, like written publication I did under Across the Spread. It's available on Substack, free to read. That explains that whole move. But so we just got the data out yesterday, and turns out the Ministry of Finance was indeed not involved in that. 150 USD JPY is a level that is so focused on by markets that it becomes a self-fulfilling market prophecy. There's limit orders and stop limit orders, layers upon layers upon layers of them. There's there's options positioning all around that level that once it touched that 150 on, was it October 3rd, and you saw that spike down, that kind of flash crash, that's basically what triggered that. And the thing is that what I was saying at the time was like, I don't think that this is Ministry of Finance, because early data also showed that, like, if you look at kind of interdealer FX trading volumes and all that, that was like 6x higher last year when they actually intervened than this time as well. But more importantly, it went from 150 down to like 146, 147 handle, but then right back up to 149.50 within this span of 90 seconds. So if that was the bank, if that was the Ministry of Finance, blasting tens of billions of dollars at market and intervening, and all they bought was 90 seconds of time, then what I was saying was, you watch out for before the end of this month, a true intervention to come up, because they're gonna have to cover up the fact, if they come on record saying like that was indeed intervention, that's gonna look like their interventions are completely ineffective. So they're gonna have to really blast it and just kind of cover it all up, because it all comes out as one figure. So but I think that right now, though, the Ministry of Finance is doing their jawboning, and they'll probably get involved at some point. But they're so again, purposely elusive about this, about what level and all that, that we simply don't know. And I think that this Bank of Japan move, from the past day, from the October meeting, was actually a sort of yen intervention attempt from the Bank of Japan, as much as it was just only about rate policy itself. It didn't really work as far as we can see right now. But I think that because they pre-leaked it 12 hours prior to the policy, and then you did see yen strengthening. So I think that they took that as confirmation that, like, okay, this will be the market reaction should we do this. And when they did it, the market reaction was not there.
Mm. Weston, I'd also like your take on the sort of broader ramifications of the weak Japanese yen. Earlier this year, we had headlines in various Western media outlets about the risk of a snap election in Japan. And the Japanese yen has obviously weakened since then. So how important is the currency for the local population in Japan, and what's the mood like in Tokyo right now?
The mood is glum, my friend. Unless you're one of the foreigners who are able to come to Japan in this massive tourist wave, because the entire country's on like a 30% off sale rack. But and you guys should come too. No, you're absolutely right. Like, I love that you're thinking of it from that angle. So the Kishida administration's approval ratings are getting decimated, and I have this chart from Nikkei that just shows that, like, his disapprovals and his approval ratings. And it really does come down to dollar yen. So I actually superimposed this chart of USD JPY on top. Now, mind you, that chart is shifted by a few weeks, because spot, real time dollar yen prices, and when servers are taken and published, you're gonna have a lag. But they match up in directionally and all that, right? And it's not that, like, it's not a matter of like Japanese citizens, the everyday citizen, is pissed off at this specific level on the foreign exchange rate. But it's just that general yen weakness causes net misery in its own economic, its own idiosyncratic ways for in various ways. Like, yes, you do have exporters who can benefit off of that. That's hence seeing the Nikkei, jump 2% on this latest BOJ meeting, because of dollar yen, rising and all that. But net, I mean, you're talking about like this country that has to import everything. And the weaker the yen gets, the more expensive everything gets as well, and energy imports and all of that. And so it's causing, people are basically pissed off, and they're not happy with what's happening economically, and they're blaming the elected officials in government, also as a function of not really understanding monetary policy, because the regular person doesn't concern themselves with that, as they shouldn't. But yeah, the yen is a massive factor, and so when you see things like the Kishida government suddenly doing tax cuts right before, like, these very important elections from last week, when he's been talking about tax hikes for military spending, there's this. It's not even a meme anymore. It's like, this is like this thing that's going around talking about him and his glasses.
Mm.
They basically are talking about Kishida's glasses. Then they started nicknaming him tax hike glasses. Then they started nicknaming him, and I'm not kidding about this, tax hike shit glasses. And now they're calling him like liar glasses, because you're saying like, oh, this is like a tax refund and all that. So people are very, very not happy at all with the administration. But it really does come down to the yen. The yen is a barometer of economic misery in Japan.
Mm. Weston, I have a question. I've operated under this thesis that ever since they really started to tweak the policy, that they've had this, the Bank of Japan, that is, this objective of sort of attempting to normalize monetary policy in general, actually having a monetary policy versus actually just exercising the yield curve, as you quickly put it. And I'm wondering, and I don't really have an answer to this, so I hope you can help me out. What would it take for the Bank of Japan to start to tweak on the front end? And what are the political implications if that was to occur? What would be the necessary precondition, you think?
Yeah.
Putting you on the spot here.
So no.
Okay, fair enough.
Let me. This is why it's difficult to answer. So normalization is defined in normal other countries. Okay?
Yeah.
It's not a normal country, right? So yeah, like Simon Kuznets, right? Who famously said there's four types of economies. There's developed countries, there's developing countries, there's Argentina, and there's Japan, right? So it is very idiosyncratic. So normalizing for Japan, I mean, Japan has been in a state of radical experimental easing and low rate environment and all that kind of thing for the better part of, like, several decades. What does normalize mean for Japan? I think Japan, for normal policy in Japan, might be kind of permanent easing, right? But if you're talking about like how other country, how other major developed countries and areas define normalization, as in like the act of getting out of like emergency support and back to where levels of interest rates and all that pre that emergency taking place. If that's what you mean by normalization, or at least getting out of negative interest rates for Japan, the last major with the front end there. I don't know what it will take. It will be, according to Governor Ueda, it will have to they'll have to likely see if like wage, upward pressure on wages sustains, and so therefore probably not till April, if they are indeed being sincere about that. I don't know if they are.
Mm.
April is when you would get, actual wage negotiation data and all that to confirm or not that. So there is that. But if you look at, like TONA futures activity and open interest, it's really starting to pick up now. So people are now starting to bet on the front end of the curve instead of just like 10-year JGB yield, 10-year JGB futures as well. So it is getting very interesting to see that. But yeah, that would be like, the two deputy governors of the Bank of Japan that were brought in with the Ueda regime. One of them is a Bank of Japan lifer who's been there, who's been the policy architect, Uchida. The other guy is from like the banking sector, and I think that he'll have a lot of say as to removing that negative rate, because if they do that, it's going to be I'm not saying profitable for banks, but it's going to be not a drag on bank earnings and all that. So I think that that'll also have a lot of influence on that. But what I will say though is that front end, like as far as banks are concerned, we just got data out, or announcements out from over the last 24 hours, like in light of this new yield curve control change, that like MUFG, which is like the largest lender, like commercial lender here, or retail banking here, they are going to increase their deposit rate from like 0.1% or something to like 10x that, which is still very low. But nonetheless, they're going to do that because of this back end, or the longer end. And then you also see Sumitomo Mitsui Financial Group. They're taking their dollar deposit rates from about nothing to 5%. So that's a massive change. Yeah. So I think it's to stop capital flight, I guess. But those adjustments are already happening with the front end, like already even in negative territory because of the longer end. So
Yeah,
I don't know what will influence that as much. Yeah.
Fair enough.
and I think as of today, roughly 25 basis points are priced in worth of hikes over the next 12 months, thereabout. Pretty interesting stuff. One thing I'd like your take on as well, Weston, is that we've seen quite a few headlines on Bloomberg and Reuters and other media outlets where Bank of Japan members have discussed exiting negative interest rates before year end. And I always say to our clients, when they say year end, they mean the April to April fiscal year, not before New Year's. And we struggle with the understanding of that as well. So I guess I'm right when I'm saying that they're talking about April next year in case they want to exit it, right?
Yeah, I think that they might be purposely trying to not specify. Like, I think that they say, like, by year end, and then if it suits them, they'll be like, no, we meant fiscal year end, as in, like buying themselves, or they'll say like, no, we meant calendar year end, because of this arb of like this understanding arb, which you have cracked, and so therefore like you're not a friend to them by doing this. But but I think that I'm serious. I think that they're trying to, again, flexibility, optionality. That also includes how they conduct their language and all that. They can just say by year end, and hopefully people will just have split opinions on that, and they haven't painted themselves into a time corner, let alone a price corner.
Yeah. The final question, Weston, relates to the inflation outlook in Japan. It's something that I haven't experienced through my professional career, that we actually talk about inflation above target in Japan. The new forecast from Bank of Japan puts inflation ex fresh food, the one that we typically track, at 2.8% for this fiscal year, and then again at 2.8% for the fiscal year of 2024. So 2 years in a row with above target inflation. What's the local coverage like? Is it actually a theme that inflation is now running wild in Japanese terms relative to what you've been used to?
It is running wild in Japanese terms, and in reality terms, right? Like it is crazy that you're seeing that. But with the X food component, so the food inflation part is massive in Japan. And first of all, also their targets, their changing of the targets, it is just for show. It is just for, so as to, I guess, justify or not whatever this is doing. Again, however it suits their narrative, they could have it sort of both ways. But that way, they're right on that cusp of like, yeah, but we need to see, we are there so that if they want to continue to, lift policies, they can do that and justify it by pointing to data. And then they could also point to data to say like, but it's not, it's still kind of ambiguous. It's still too far out there. We need more confirmation before we can move and all that stuff. So they can have it both ways with that. But what I will say is that when it comes to inflation in Japan, it is very, very much real. But do not underestimate the entrenchment of deflationary mindset in Japan. Like that is, but there are generations that only know prices staying the same or going down. And that they reflexively, and stores that reflexively will cut prices. You can't just get rid of that in a one or two like monetary policy changes on Bank of Japan's yield curve control that people have no idea about, right? The one anecdotal thing I'll say is like there is a chain of um they're called oyakodon, is basically like this like dish of chicken and egg and rice. It's very delicious. It's good hangover food.
Mm.
So their main thing is like eggs, right? And we had egg inflation, everywhere earlier this year, right? When that was happening earlier this year, like this summer, one of these national food chains that do this, kind of like a Yoshinoya sort of thing, right? They actually cut their prices on that egg dish, not despite egg inflation, but because of egg inflation. Because their business strategy was, their competitors are all going to be raising prices. We are going to grab market share and cut prices. So they cut prices on their egg dish because of egg inflation. So like that's a one-off example, but that's like very emblematic of the general sort of broader mindset. Like it's not about growth, it's about taking market share, and you do that by cutting prices, and because consumers respond to that too. So they'll go somewhere where it's like 30 yen cheaper.
Yeah, they do that with milk where we live. Believe it or not.
They do that with gasoline in the United States.
Yeah.
If you look, like there's like down to like 1/8 of a penny, you'll go to that 1/8 of a penny less. That's how Japan is really. It's so you can't just get rid of this. Now, what I will say is that I think that it would be a very like completely non-considered risk, and I don't think that this is a big risk at all. But if like genuine domestic induced CPI, consumer inflation prices due to like higher wages and all that were to happen like on this cycle, watch out, because what happens when Japan, with their 55% of household assets in cash, what if that gets unleashed onto real goods out there? You're gonna see like supply chain. You're gonna see like massive global inflation stemming out of Japan. And I know it's an insane thing to say or think about, but it's not a 0% probability. It's like a 0.1% probability.
Good point.
Let's conclude with that doomsday scenario. Japan leading a global inflation wave. I don't think I can handle anymore.
Can I actually just make one broader point about the Bank of Japan, like from because in light of the Fed, because we're coming off of the Fed, who just are just sitting on their hands. ECB as well, right? So Bank Japan's influence and impact, yes, it's obviously massive, as you know, on the world at large. But I think that now it actually stepped up its game in terms of the influence, because Bank Japan's impact on other central bank policies, like the Fed, for example, I think is now becoming evident, because right now the Bank of Japan, at their last press conference, they've been blaming U.S. Treasuries and U.S. Treasury yields for this JGB and JPY sell-off, right? When it was the Bank of Japan who, by and large, had triggered and exacerbated that move since that July yield curve control change in the first place, right? They lift the bands, they trigger a blowout of the long end of the curve overseas, right? And then they're blaming U.S. yields now for that. Like, well, you're the ones that did that to U.S. yields. Okay, now if the Fed is saying that yields and term premium is doing the tightening for them, right? That's another way of them saying that the Bank of Japan is doing the tightening for them. In other words, did the Fed and ECB just hand the baton off to the BOJ? Or another way to say it, did the BOJ just snatch that baton out of the hands of the Fed and ECB? And that's why they're like kind of, we're done for now, because the Bank of Japan has now taken this baton. And so now is policy, global hiking policy, if you will, and tightening of financial conditions is going to be run out of Tokyo.
Yeah.
So that's what I'll leave you with.
That's a really interesting point, and one that I haven't heard from others express that clearly. So a great point to conclude the interview with. Weston, if our audience wants to sort of follow your thoughts on how Asian markets and Asian decision makers impact global trends, where do they find you?
They could find the best information of that at Macro Sunday and at Steno's Research. But if they want an alternative, so if you go to acrossthespread.com, it's a platform I just launched. And if those of you who've seen my previous podcast, Market Depth, in which we're talking about market developments that happen out of the Asia Pacific region and how they apply to the global, market landscape as a whole. It's an expansion of that, and I'm just basically now doing that independently via various mediums. Like I said, I have podcasts as well as adding written material, and a lot of other things coming as well. But if you go to crossthespread.com, that's where you'll find everything. That's where you could find me as well.
Weston Nakamura, thank you very much for being with us. It was such a pleasure.
Thank you, gentlemen.
Back from the interview with the great Weston Nakamura of Across the Spread. A great guy.
Yeah.
Almost half stand-up comedian, half Bank of Japan analyst. I love it.
Yeah.
I mean, he's certainly great company.
Definitely.
And very much an eye-opener to me, this concluding remark surrounding Bank of Japan now being handed back the keys from other G10 central banks. I think there's some merit to that view, that Bank of Japan trends have played a major role in global fixed income trends, say, over the past 12, 18 months. And now with this flexibility, it's a bit tricky to figure out which direction to lean in.
Yeah.
So from a portfolio standpoint, Emil, we have to get to it at some point.
Yeah.
It's not easy to figure out whether to be leaning long risk or leaning short risk in this environment, because you really risk chasing pennies in front of a steamroller here, right?
Yeah. So to the extent you do, you should definitely be to take caution in doing so. But yeah, I think there are pretty good odds that all the crap gets to party to to say it as it is. Have it be small caps beaten down tech, the small ones, all those indebted above both ears, crypto perhaps. All that could really have its time in the sun, but I think it will be brief. And be careful out there.
Yeah. And back to the discussion on the issuance projections from the budget office in the US and the Treasury issuance plan by Janet Yellen and her team.
Yeah.
I'd like to play a soundbite for you because obviously statistics are here to be manipulated. And the best manipulator of statistics out there is called Don McMillian. And he travels the world with a show on how to manipulate statistics. And let's listen to him for a minute or two with some of the best examples he's got on how to manipulate statistics. It's hilarious as beep. So here's Don McMillian.
What else have been heard? Big data is how we live by big data. I love statistics, big data, analytics, whatever it is. But here's the thing. When it comes to big data, there's a lot of bad data out there. Because statistics can be manipulated. To show you how you can manipulate statistics, these are actual true statistics. Watch what I do with them. These are actual true. It turns out in China, there's about 1.4 billion people in China, right? 1.4. There are 7 billion people on Earth. Therefore, statistically, it cannot be argued 1 out of every 5 babies born on Earth are in fact Chinese. So you could say, statistically, if you got 4 kids, you're expecting a 5th, it will be Chinese. So don't be surprised. That's all I'm saying. Don't be surprised. I don't have a problem with it. Usually your 5th kid's going to be Chinese. Just deal with it. So when you hear a statistic, always ask about the other side of a statistic. Ask, look at it from a different perspective. 44% of marriages end in divorce. 44%. Now, that's a scary number. That's scary. When you first get married, you're like, oh my God. But here's the thing. It's not so scary when you look at it from a different perspective. If 44% of marriages end in divorce, you know what that means? 56% of marriages end in death. Those are the 2 ways that marriages end, folks. Apparently this is just occurring.
And he goes on and on. But I love his ability to manipulate statistics in a very clever way, because everything he says is actually, it's true, but obviously wrong, right?
And too many pros actually do that unintentionally.
And journalists. But Emil, when we look at this issuance data because
Yeah.
I mean, given the amount of attention it's gotten, it will obviously impact portfolios
Yeah.
if these projections are wrong.
Yeah.
And one thing I'd like to get your take on is how to predict issuance amidst political turmoil.
Yeah.
We had a discussion, you and I, earlier on at the office
Yeah.
on how to, I mean, add a statistical probability, whatever, for a shutdown, for automatic spending cuts if they do not agree on appropriation bills, etc. in the US. So do we even, with any degree of certainty, know the issuance pace here?
Not really.
No.
But we can say that two different estimates aren't equally good necessarily. I think that's probably the better way to think about it, right? So I mean, it's really difficult to add probabilities to political uncertainties first and foremost, right? That's difficult. But there are some expenditures which are more or less known, and we know to what side the risk is tilted. For instance, when it comes to a good one is defense spending. You know what characterizes defense spending? They always need more money when it comes to the US. They always need more money, and it's one of the areas which are really difficult politically to manifest cuts in. So and but what is the situation right now with geopolitics, war everywhere? Increasing demand on defense expenditures, if nothing else, just to restock all the ammunition that's sent abroad, right? That's not really reflected that much in the CBO projections, I would argue.
No, and it's politically toxic to reflect it, right?
Yes, as well, right? So, no, there are many, there are many areas of the budget that are characterized by such dynamics, really. And I think the other side of it, we tend to speak of the US dollar wrecking ball. And I would argue it's really a US Treasury wrecking ball, right? So to the extent there's a really forceful push on US yields, all other currencies are going to suffer unless they have done in this cycle, try to hike along. And there are not that many countries out there that can stomach that much suffering, especially not here in our continent, right?
No.
So what I think 75% of private debt in Europe is variable rate, and it's the exact opposite in the US. That should tell you something about the capacity to absorb.
Our friend of Apollo, Torsten Sluk, a Dane, being the chief economist of Apollo, the credit fund, he distributed a chart late last week on the composition of high yield and investment grade debt with which needs to roll basically through 24, and the European equation looks much worse than it does in the US, basically due to this fact that you just listed. Which makes for an interesting case for interest rate cuts, I'd say, in Europe, because they will essentially be needed faster than in the US. I still think that's very much the case.
That's our base case in house, right?
So if we look at forward pricing as we speak, roughly 60 to 63 basis points priced in over the next year in terms of cuts from the Fed, exactly a year from now. 77-ish from the European Central Bank, and much less, roughly 35-ish for Bank of England. Fixed income in the UK, an obvious buy here, given that.
I think the problem with the UK in general, one of our clients actually asked me to this, and I think what you have to take into consideration here is the state of the financial sector, and that looks pretty dire in the UK, generally speaking. Would I buy UK risk hand over fist here? No, I wouldn't. But I think soon enough, I would probably start to add to it. I don't think that the UK economy can really take all this pain. from monetary policy much longer. So yes, I'm on that ship as well.
And the Bank of England essentially started acknowledging that the labor market is now suffering.
Yeah.
Which is not really the case around the Eurozone and the US yet. Not to the same extent, at least.
No.
We obviously see some trends towards weakness, but
Yeah.
not fast enough, not material enough to really sound the alarm yet.
No.
But I think it's about time to sound the alarm around the UK. I mean, that's basically my main message here.
I still think that an interesting joker into all that is we see that in the US. We see strikes, right? We see actually corporations sort of, because they essentially are in a good spot if they're big and they got plenty of ammunition, just caving in and paying up. I think that would be tougher in Europe. But on the other hand, there are plenty of people in the European labor force who've gotten absolutely battered from inflation. I have plenty.
Sorry, I'm not. I shouldn't be laughing.
No, but so that's an interesting dynamic thrown into the mix, right? Yeah. So unions, strikes, that sort of thing, and I think it comes at a quite unfortunate time because what a corporation that are facing margin squeeze going to do when the workforce turns up and demands wage increases, right?
Yeah.
Equals layoffs. So yeah, I think everything points to easier conditions in the labor market. That's my view.
So here's the bottom line of the week.
Yeah.
There are some reasons to lean into duration, but better reasons in the Eurozone than elsewhere. For now, maybe UK.
Yeah.
I'm not convinced that US duration is on a path towards strong performance right here, right now.
No.
I know it looks like it right now, but I consider it a bit of a false flag.
Yeah.
It also carries the risk that we celebrate for the wrong reasons here. That just because interest rates see some tailwind towards lower interest rates in the far end of the curve, we just automatically say, oh, we need to buy tech and cash flow extensive stocks, or the opposite, not cash flow extensive, but companies without cash flow. That was what I intended on saying. And all that. There's a clear risk that we basically misunderstand why central banks are pausing. It's very typical that we see that short-term reaction ahead of a recession, but I think there are more and more signs that this actually aligns with the recession playbook, also from a market perspective. I guess that kind of sums up a very, very tricky trading week. Probably a bit of party for the next couple of weeks, and then let's see whether we have a headache after New Year's.
Yeah, but it doesn't take much more than a negative surprise, and I don't know, from some labor market data, wherever then everything's back to the floor again. So it's a sugar rush, and the thing about bear market rallies is either you ride the wave or you await entry for shorting it, right? It's tough to time. So
it is very, very tough.
Keep that in mind.
That was all for this week's edition of Macro Sunday. Remember, if you like what you heard or liked what you saw, go to standardresearch.com. You can use the coupon code MACRO30, MACRO30 to get 30% off your first subscription to Standard Research. We have a live portfolio, actionable content, data hub, which is now currently being improved fast with a load of good material, and then 25 to 30 research pieces a week on everything global, including Japan, China, LATAM, the US, Europe, you name it. Thank you very much for watching or listening out there. I'll see you again next week.
Bye.